Welcome back, guys. Another value investing video here because today I'm glad to have Christian Caille as a guest. Hi, Christian. Thanks for coming.
Hi, Domenico. Thank you for inviting me, for having me here.
It's really a pleasure because Christian, as a value investor today, is going to present a company that he is deeply studied in. In fact, Christian and me, we belong to a group of value investor. We have been certified in this case from eToro platform, and we both have our public portfolio in eToro. You will find the portfolio down below in the description if you want to have a look deep into. And today, Christian will give a presentation of to even understand how much work there is behind every investment and what is to be a value investor, what is asked to be a value investor. And Christian, for the one that do not know you, do you want to briefly introduce yourself?
Sure. As you said before, we both are part of the eToro Value Investor team, and I've been in the team for a few months now. And beyond that, I also work as CFO of a Spanish company here in Mexico, for Mexico and Central America. It is a subsidiary of a Spanish company that is listed in the IBEX 35, that it is the main index in the Spanish stock exchange. And well, I do this in the time I have left for myself. So it is like a passion that I have. And as you will see, it takes a lot of effort, a lot of work, and well, but I think it is rewarding if it works, because it sometimes don't work the way you want it to work. But anyway, you can learn from mistakes, and I think that is what builds our knowledge and the way we work.
Yeah, our portfolio will tell us if everything will work, and for sure it will, because I know how you are deeply in investigating in a company. You will just show this in a while, and even because it's your job to be a CFO, so you really know about numbers. And I really wanted to see your presentation. I know you are going to present, in this case, the company is Vistra. Do you want to start with the business of the company and to explain what the company is doing?
Sure. First of all, I have here a brief index. This is what we are gonna see today in the presentation. First, the company. After that, we will be looking at the industry of the company in which the company operates. And after that, we are gonna value the company in two ways. The first is the net asset value of the company. We are gonna watch the balance sheet of the company, if it is properly accounted or maybe not. After that, the earnings power value, that is the multiple we are going to apply to the EBIT, the sustainable EBIT that the company is expected to generate from here to the end of the times in perpetuity. And finally, the conclusion. So what I expect us to know about the company when the presentation ends, I want to know the price target, why this target price, and why it is different to what Mr. Market is valuing the company right now, and the catalyst for that gap to close. Okay.
Perfect.
So, starting with the company, the company is an electricity producer, and it has also a retail distribution business. Both businesses are inside the same company. And before, we will see the history, but before they also had a transmission business. But when the new IPO came, it stayed out of the IPO. And we see that the company, when we are valuing the net asset value, has several plans to generate this electricity, mainly nowadays gas natural plants, and that is what we are going to value, and that is why we want to watch at the industry how it is going to evolve in the future, if natural gas plants are worth something or they are just going away in the few 3 or 4 years. And finally, the long-term strategy to reduce carbon emissions that the company is trying to bring to the company to create more value.
But do they have just electricity network or even pipeline?
They have they have many gas natural plants nowadays. They also have carbon and oil plants that they are gonna close in the foreseeable future, and they are also investing in solar plants and renewable plants, and they are already building some solar and storage solar plants, and they will be building more in the future.
Yeah. Perfect.
So a brief history of the company. When it went public in the first time, it was called TXU. It has beyond the production plants and the retail distribution, it also had the transmission of the electricity for its network. But in 2007, there was a leverage buyout for $44 billion. It was the largest leverage buyout in history. And even Warren Buffett bought a part of this leverage buyout. And it was clearly a bet on natural gas price. But with the disruption of shale, this fracking new industry that came natural gas very cheap, the company actually went bankrupt in 2014. In 2016, there was this separation between the transmission part of the company and the producing electricity and the retail part of the company, and it went public in 2016 without, as I say, the transmission business that it stayed out. And since that, there has been a lot of activity in the business, mainly the Dynergy merger that came like $10 billion of plans to the new company. It was called Vistra. And more recently, in 2019, the company bought Ambit and Crius, that it is mainly focused on the retail part of the company. So as we see, they are both growing through inorganic growth by buying or merging with some companies of both in plants, in distribution, both in plants and in distribution. So not just in the producing energy. And some facts of the company today: the market cap is around 11 billion. The enterprise value, that is the market cap plus the debt minus the cash, it is a bit above 20 billions, with a PE ratio of above 12 times, but with a price to free cash flow of 5 times. That is a 20% free cash flow yield for the company each year. That is one of the facts that make the company so attractive to watch and to learn more, and maybe you want to see if that free cash flow is sustainable or not, because maybe it cannot.
Enterprise value that they have a lot of cash,
a lot of debt.
Yes.
Yeah.
You are true. We are paying 20 billion instead of that 11, so they have a lot of debt. Yeah. And but they make cash from the cash flow that you said that is a 20% yield.
Yeah, actually the company said, well, the directors of the company said that they could, or they are gonna use this free cash flow in the next 9 years to buy back the whole market cap of the company at current prices. So just by doing that, you know that you'll get double your money in 9 years because of buybacks if everything else remains the same.
It will be great if it's true.
Hopefully. So going forward, this is what I said before, that they are switching the production model of the company from a carbon model to a free carbon or low carbon model within the production of the energy. So as we see here, we have a 20% coal right now. The EBITDA of the company comes from a 20% of coal, 44% of natural gas, 27% of the retail industry that they have. The margins there are a bit lower than in the productions part of the company, and a bit of renewables, also a bit of nuclear. But in the foreseeable future, we see that in 2030, they expect that 90% of the EBITDA comes from retail and low to zero carbon. That is both natural gas and renewables in the company. And for 2040, they expect that carbon-free, absolutely carbon-free, that is everything renewables or the retail part of the company, will be accounting for a 70% or 80% of the total EBITDA, and low carbon, that is natural gas, will be from 20 to 30% of the EBITDA. So we see that they are not just betting on renewables, they are also betting on natural gas for the energy production in the future.
But they will still with nuclear. I can see 6%. Is true.
Yeah, they have a plant, a nuclear plant, and we will see in the balance sheet that they have this investment in the nuclear trust to unveil this nuclear plant when it is over. But usually these plants live very long. I don't think they will build any new nuclear plants. Actually, we will see the scenarios that we have in the future for this, and nuclear remains the same. That is, there won't be new nuclear plants, but the nuclear plants that there are right now, they will stay with us. Yeah.
Okay, perfect.
And this is the outlook of the industry. As we see here, I use the U.S. Energy Information Administration latest report. And in their base case, they say that renewables will be the energy that will grow the most. But after that, we will have natural gas that will grow steadily from now to 2050. Of course, coal produced energy will decrease a lot because it is the one that creates more carbon beyond some other things like mercury or some other bad particles that go to the air. And nuclear, as I said, it remains very stable in the future until 2050. Okay, this is the base case. We will see that there are also some other scenarios where renewables grow much higher than this, and maybe natural gas won't stay the same or maybe even lower. And there's another scenario where the cost of renewables stays quite high, and then natural gas will the one growing the most. But the likeliest scenario, the scenario that is more likely in the future, is this one that we are seeing here.
Perfect.
Okay. Here we see the other scenarios. It is in every scenario that we see here, we see that there will be new natural gas and oil plants, but mainly natural gas plants, building up in the future, and the retirements will be mainly coal plants. There will be also retirements of natural gas plants, but it will be mainly because of the age of these plants. Okay. And as we see, the main scenario is renewables, especially solar, growing a lot.
Yeah, for sure. For the next future, we expect gas and solar.
Yeah, the thing is, natural gas produces carbon, but this produces between 50% and 66% less carbon than coal plants.
Yeah.
So the reduction of carbon is huge. And we also have the advantage that natural gas plants can produce and can start producing electricity whenever you want, as fast as 20 minutes. If you need energy right now, you just have to wait like 20 minutes to produce it, because it is easy to start producing energy and to stop producing energy, just to provide the network with enough electricity. And that is something we are seeing today in Texas. That is the main place where Vistra is producing energy. With this snow frozen environment they had, we've seen that solar plants can't produce because there is no sun, and wind plants can't produce because there is no wind and the turbines are frozen. So you just have left coal plants and natural gas plants. And mainly natural gas plants are seeing their production growing the most these days, because they can start producing whenever they want, as fast as 20 minutes. So
I can add that for the maybe late future, natural gas even possible to work with hydrogen as well. So it will be the first step to go into hydrogen.
Exactly. But right now, there is no foreseeable future with these plants working with hydrogen. But it could be a way to go.
It's late future. It's like, say, let's say in 10 years or 20 years.
Exactly. So this we are seeing here now is the balance sheet of the company. Untouched. Just like it is in the third quarter of 2020, that it was reported a few months ago. And as we see, the value of the equity is over $8 billion. That means that we are buying a company today with a market cap of $10 billion, an enterprise value of $20 billion, with a tangible, well, not that tangible, but with a book value of 8.4 billion. And to this, we are gonna do some adjustments. Where we are gonna adjust these things? Well, mainly in property, plant, and equipment. That is the plants they have to produce this electricity. There is also a bit of land. It is like $600 million of land, but we won't consider that to be as much conservative as we can. After that, we will watch the intangibles of the company, this goodwill and these intangible assets that they value themselves. Everything of this come from the acquisition they've done before. And finally, the receivables. Receivables are very easy because you just have to add back the bad debt provisions, because if you want to replicate this business, you will have those bad debt provisions the same way that they had. It doesn't move much the final value of the company. So as we said, we are gonna calculate the reproduction cost of this company today, but we are gonna do some further adjustments just to make sure that we don't value some things that won't be that won't create value in the future. So as we see that coal and oil plants will vanish in the next 5-10 years, we will adjust the value of those assets to just a 5% of the total value that we can calculate. And there are several plants that are going to be retired for here to 2025 and 2027, and we are not gonna value that. The value of those assets that are gonna be retired in 4 or 6 years is zero for us.
Okay.
Just to be conservative. And finally, we are gonna depreciate the calculation of the reproduction cost at the same rate that the company has currently depreciated their assets. That is at 20%. So to do this calculus, we are gonna base our or calculations in what would cost today to build these plants. This is the average cost of building these plants in 2018, and it is provided like before the scenarios before by the US Energy Information Administration. That is the average cost of 2018 that was collected this data in 2019, and it was published in 2020.
Okay. That one is one, for example, solar is $1.8 million.
Not. It is the price average. It happens that you can see that, but it is the kilowatt price average. Kilowatt. It is $1,800.
Okay.
Per kilowatt.
For megawatt is okay. Yeah.
Exactly. And per megawatt, that is like the higher magnitude of energy mediation. Per megawatt, it is $1.8 million per megawatt.
Okay, perfect.
Okay. Well, here are, I don't know if this is clear to see, but here are all the plans that the company has. We can maybe share this presentation in the comments below.
Absolutely.
So it will be easier.
Presentation down below in the description.
Exactly, because this way it will be easier, but there wasn't another way to share this. So all these plants, as we can see, there are many gas plants. There is one nuclear plant, one solar, and several coal and oil plants. So the ones that are in red, those are the plants being retired. The company has already said that in their financial statements. They are going to be retired in 2025 and 2027. So as you see, we do an adjustment of 0% of the value of that asset, and that is zero for our valuation of the company. Although they will generate some cash in the foreseeable future in these 4 and 6 years, but for us it will be zero, just to be conservative. Okay.
Perfect.
So as we watched before, we have a column with the net capacity in megawatts. That is what we will be multiplying for the building cost that the company has, times the ownership, because they have several plants that they don't own it completely. They have an 80% in some companies, in some assets. And after that, we will do another adjustment. The 5% of the value that we have calculated for the oil plants and the coal plants that won't be retired in the foreseeable future. And after that, we will do the depreciation. So we see that the reproduction cost of these assets, if they were new, it is above $65 billion. But after the adjustments of the oil and coal plants, it is down to $33 billion. And after depreciating, because they are not new, these assets, and doing the adjustments of zero for the plants that will be retired, we have a net value of these assets of over $26 billion.
So just to recap, so we have some oil and coal plant that, let's say, they are worth on the book value 1 million, but we consider just 5% of this million in our evaluation.
Exactly. And further, we depreciated by a 20%.
Okay. Then we have, for example, the one that you do not consider because they are going to be closed in a few years. So they are still generating cash now, but we do not consider because we are in a conservative case. And the total amount of the plant, the asset that they have, it's something around 26 billion, considering already the conservative adjustment that we have done, plus depreciation.
Exactly.
Okay.
That is it. There is a $13 billion difference between what we have here and the number that the company has in its balance sheet. Where does this difference come from? Because they can do this too, and maybe they have, and surely they have more information than what I do of what it cost at the first time to build that assets. But they are to value these assets. Most of them come from the merger that we saw before, and they are valuing this regarding the operation that have occurred in the private market. That is, how much is it cost to buy these assets from another company that doesn't want them, and they also do a discounted free cash flow of every asset with a 9% discount rate. So with these two kind of valuations, according to the financial statement, they weigh the same for the calculus, and they arrive to a $13 billion dollars value. And by doing it as if we would build these new plants, depreciate it because they are old, and the other plants, oil and coal, going close to zero value, we still have that the value of these assets today is above $26 billion.
Perfect. Okay.
And then further, we have the adjustments of receivables and intangibles. And the receivables, as I said, is very easy to do. We just have to add back that bad debt allowances that they have to know the replication cost of the company of these receivables. And then goodwill and intangible assets, we take them to zero, and we calculate it again from zero. So goodwill and intangible assets are zero for us, but we have to know how much would it cost us to replicate this knowledge of the company, this know-how, this portfolio of products. And we can do it for several metrics, maybe calculating the workforce, maybe the value of the brand, maybe the portfolio of products with the life cycle. But we will do something easier here. We will use a proxy to calculate these intangible assets of the company, and we will use the general cost, general and administrative cost, and we will use a multiple of 2 times this general and administrative costs to calculate all these intangible assets as a proxy. We see that then this adjustment stays at $2 billion.
Okay.
And we see that the own company, when buying these other companies of retail distribution, they do a calculus by themselves with the portfolio of products, and they value it at $2.4 billion. So we are not that far, and I think we are being more conservative than the own company doing this valuation. Perfect. So doing these adjustments, of course, liabilities stay the same. We think they are properly valued. There isn't much to what's there, actually. So we arrive to a net asset value of $21 billion. This compares... Yeah.
No, tell.
This we have to compare this with the market cap of the company, because we are already deducting the debt. And we see that we have a 100% upside for this company, and we have a margin of safety of 50% from our valuation to the current market cap of the company. Just regarding the assets, we are not seeing if they have a strong competitive position, if they will maintain that 20% free cash flow yield in the future. Just regarding the assets, we see that the company is clearly undervalued.
Okay, so the company right now has a valuation of the asset that is lower because maybe some different calculation that they have done. But in your thesis, you started from the point that if we want to build again the plant today with the value that you showed us before, and with depreciation and adjustment, actually, if we want to replicate all those assets, we comes to an evaluation of $20 billion.
Exactly. That is what the thesis is built up on. So, of course, you can say, okay, you can go to the market and buy these plants cheaper than what it would cost to build them. But eventually, no one will want to sell an asset for 4 times free cash flow yield, because they will stay longer than 4 years. So after the selling pressure of those assets will vanish, the price will be higher, and it will equal the cost of building it from zero again. So I think it is a depressed market because people don't want to buy these carbon plants, but they are generating a 20% free cash flow yield. So it is ridiculous, actually. They will keep generating value in the future. And if you just sit down and wait for the dividend or the buyback to come, you will generate a greater income than, I don't know, buying the ESP 500 maybe.
Yeah, for sure. Because the capitalization of the company right now is 11 billion, but if the assets are just worth 20 billion, there it's our margin of safety of 50%, actually.
Exactly. It is huge, and it is based just in the assets of the company. Of course, we are gonna watch the earnings too, because we have to do it. But I'm gonna advance you some information. I don't see the company having a competitive advantage to create more value, to create value by growing. That is that the return on invested capital is not over the WACC of the company. Okay, so that is why we will see that the net asset value and the earnings power value are similar, or even the earnings power value is a bit below this net asset value of the company.
Perfect.
So again, now regarding the earnings of the company, we have to consider several scenarios. The first scenario, well, the scenario we are going to manage is the company having a sustainable 14% EBIT from now to the foreseeable future. And to do that, the company already has the EBIT margin, but I've also researched the competitors of the company. Do they generate a 14% EBIT sustainably or don't? And what I've seen is that in the last 10 years, all the competitors of the company, well, several competitors of the company, as an average, generate a 15% EBIT margin. Okay. Of course, there are companies that generate 20%, and there are companies that generate 5%. But as an average, these competitors, during the last 10 years, they have generated a 15% EBIT margin. So I think it is conservative enough. And we will also normalize depreciation and amortization, because we will do this adjustment because capex of the company, the maintenance capex of the company, is around 600 millions, and the depreciation and amortization is over $1.8 billion. So it is very high. I think they are over depreciating the plants that they have, mainly because of this carbon-free environment that we are building. But I think it is over depreciation. We will assume a normalized tax rate of 25%. And in this scenario, we will use a 10% discount rate. It is huge regarding the current environment of low rates, but we will use this in this scenario. And we will present two different types of a scenario, the smooth and the normal. The normal is with the current debt of the company, and the smooth scenario is the one that the company tries to achieve in the future, and they've almost done it already, of having 2.5 times debt EBITDA.
Okay.
That is that the debt is 2.5 times the EBITDA. So building up these scenarios, we arrive at an earnings power value of the equity, that it is what we are going to compare with the net asset value of $13 billion, using a discount rate a bit high. That is still at a 30% margin of safety, even doing this. Okay?
Actually, right now the price of the stock is we are recording 21st of February. It's $22.9. That's why the capitalization is 11 billion.
11, yeah. It is like 20% currently, a margin of safety regarding this earnings power value.
Okay.
Yeah. Again, how do we calculate this EBIT? Current revenue times 14% EBIT margin. And then we adjust this difference between the depreciation and amortization compared with CapEx. We use here the maintenance CapEx. So the adjustment is 1.2 billion. And that is how we have the pre-tax earning. We apply the tax of 25%. We get those earnings times the discount rate of 0.1. And adding the debt and deducting the cash, we have a earnings power value of around 30 billion in both scenarios. And now we have another maybe more reasonable scenario, or maybe more reasonable discount rate of 7%.
Okay.
That could be more accurate in the current environment of low interest rates. And what we have here is that the company would be valued ceteris paribus at $22 billion. Okay, so that is a bit higher than the net asset value of the company, which means that the company generates maybe a ROIC of over 7%. That is, if the WACC of the company is 7%, the company still generates a better return on the invested capital than the cost of capital. That is this little difference. But again, I don't value the growth of the company because I assume that there is no value in growing for this company. So net asset value of around $21 billion, earnings power value with a 7% discount rate of over $22 billion in both the scenario, the smooth and the normal scenario, and a market cap of $11 billion. So I think there is plenty of margin of safety here to invest comfortably.
I do agree that a discount rate of 7% for this kind of company is absolutely fair. Maybe 10% is too much for this kind of company. So it's absolutely fair to consider 20 billion instead of the previous 13, even according to me.
Exactly. If you want to use the most conservative scenario of the company with a 10% discount rate, you still have a margin of safety of over 20%. Maybe it isn't enough to invest, but that is like the most conservative step you can go to value this company. But if you go to a more reasonable scenario, you have clearly a 50% margin of safety, a 100% upside. And well, I haven't mentioned the management, that I know you like it a lot. But if you want, we can talk about them maybe later in the questions. But I know you like it, so I just mentioned it.
And if in this case, I think that is this kind of company, they have a quite a stable business. So normally, if everything works okay, you don't need some genius there to run a company. But
Exactly.
let's say if you have some information about management.
Yeah, of course. At the questions, if you like.
Okay, perfect.
Okay. So as just the conclusion of this presentation, we have a margin of safety of 50%. Considering both scenarios and all that, I find it reasonable to be 50%. And why so cheap? Well, the question is clear. The answer is clear. It is because of the renewables disruption that we are having, this new green trend. But anyway, we see that natural gas has nothing to fear for here to the 2050. So we can think that this company will sustain their earnings in the future and will be profitable, of course, in the next 10, 15 years. And as catalysts, as I said before, we have buybacks. The company has already said that they will buy back the whole market cap of the company in the next 9 years. But they've also said that if with that free cash flow generation that they have, if they can keep buying new assets at these ridiculous prices, they will do it. And I think it is fair, because we've seen that in the acquisition that they had in the merger, actually, that they had with $10 billion of property, plant, and equipment, we've seen that that value was ridiculous. It is much higher. So that kind of merger or acquisitions, they really create value. So I think they are doing the right thing buying these depressed companies. We going further, we have the improvement of the investment grade of the company that will generate a lower cost of interest, and the company expects it to be in the second half of this year. So it could be a good catalyst too. And finally, they are building some renewable plants. If finally Mr. Market sees that these renewable plants are being built, I'm sure that it will get a better multiple on earnings and on free cash flow. And I think the company will have a good return in the stock market beyond the free cash flow rate that they have currently. And well, I think it is a good value pick with enough margin of safety in the current environment with fairly valued companies or overpriced companies. So finding this kind of investments, I think it is nice for us as value investors, and for everyone listening to us, I think it is too.
Did you have the possibility to have a look to the other peer company to understand if the valuation is something that is normal in the market, or it goes just in some company?
I've seen that these kinds of depressed valuation come from companies that have coal plants, oil plants, and natural gas plants. So we maybe can find value on those kind of companies, but in the companies having renewable plants, I don't find that value. Not because of the assets, but because of the valuation of that the market is offering to us currently. Because if this same company, its energy came from solar plants, just solar plants, I think that the market cap of the company would be 3 or 4 times what it is currently.
Perfect. And two words about business for sure.
Sorry, what?
Two words about management.
Of course. Well, the management, the CEO of the company, well, all the executive of the company, they get their payment is less than 0.5% of their payments are made in cash, and more than 50% of the payment is made in stock options or shares of the company. So we see there that they are aligned with us. And further, when the market crashed in March of 2020, they bought millions of dollars in stocks when the price went down. So we see that they trust the company. They think it will be its price will be higher in the future. And if we look at the experience side of this executive, we see that the CEO of the company has been in the energy sector over 35 years now. The CFO has been in the energy sector for over 20 years. And we see that all the executives, they have a background of within the energy industry, contrasted, and they are aligned with us with those payments. So I think the management, although it doesn't have to be great, I think it is great.
Many thanks, Christian, because you have done a really great job, and I know how much difficult and how much effort is needed to make this kind of research as a value investor. So really good job. Thanks.
Thank you for having me here and giving me the opportunity to share this with you.
If you want to see Christian portfolio that is absolutely public as well as mine, you will find the link down below in the description. We will leave even the presentation that you have seen even down below in the description. If you like this value investing channel, just support us by clicking the like button, subscribe if you have not yet, and see you in the next video. Bye, Christian.
Bye.